It's been a couple of months now since I opened my Trading 212 Stocks and Shares ISA, and I did a video back then explaining how to open an ISA and what my investment strategy was going to be. Today, although still very early days, I'm going to take a look at how everything is doing, and we'll probably do one of these updates every few months. To recap what I did back in April 2024 when I opened the account, I invested £20,000 in a lump sum into the cash account that sits alongside my Stocks and Shares ISA. This maxed out my ISA allowance for the year. Secondly, I opted to earn interest on this uninvested cash at 5.2%. 3. I selected my investments and portfolio and created a pie so I could better see the proportions. Number 4. I set up a direct deposit between my cash account and my Stocks and Shares ISA investments and selected into the funds that I'd selected in the proportions that I set. There are a couple of points I want to make before I get into how the strategy is going so far. And our first point is around dollar cost averaging. I wanted to get £20,000 into a Stocks and Shares ISA as soon as possible after the tax year had started, as Trading 212 were at the time and are still offering a good interest rate for my cash savings. However, I was never going to invest that £20,000 in one lump sum, as I am a cautioned to balanced investor. I might not be comfortable with a market crash the day after that lump sum was invested, and I worry about the value of my investments dropping 40% maybe overnight, and then what I would do. I didn't want to give myself any excuse at all to cash out. For me, a better way of investing with this lump sum would be to dollar cost average, and this means investing smaller amounts on a regular basis. For me, it was £500 a month. Dollar cost or pound cost averaging is a very powerful tool in investing and helps smooth out the ups and downs of the stock market. As market prices fluctuate, you buy stocks and shares at different prices, sometimes higher, sometimes lower, and hopefully get an average price over time that is lower than the value of your portfolio, meaning that you get a positive return. The bigger the gap between your average purchase price and the higher market price, the better. You have to manually opt in to receive that 5.2% interest on your uninvested funds. In doing so, your money is not necessarily earning interest as it would be in a conventional way with bank savings. Although at the time of the video it isn't, it could potentially be invested into qualified money market funds, which are a slightly higher risk than cash but still a very low risk option. Money market funds consist of short-dated government and corporate bonds, short-dated deposits, and some very other low-risk, short-dated instruments which are very similar to cash. I wanted to use the cash account of my Trading 212 Stocks and Shares ISA to earn interest for two reasons. The first is the competitive rate that they were offering, 5.2% for the UK investors and 5% in the US. And secondly, it was then the ease of transferring money from my cash account into my investments as and when I wanted to do it without any delay. My opinion is that if I was just looking to save and not invest, then savings with a cash ISA in a bank offering similar rates might be a slightly less risky and more certain option. I'm not a financial advisor, by the way, and you're going to have to weigh up what you think is best for you in your given circumstances. If unsure of anything, then consider seeking the advice of a suitably qualified professional. As I've already said, I've chosen to do what I'm doing because of that interest rate and ease of transfer between cash account and Stocks and Shares ISA. This for me is a better option rather than having to transfer money between different providers every time I want to invest, and the additional bureaucracy and delay that would cause. In the event of bank failure, when we talk about bank savings, you would have FSCS protection up to £85,000 per person. With Trading 212, you would have that same protection should Trading 212 as a platform fail. But your capital is at risk from any investments that you hold, including taking the earn interest option with money market funds, and you could end up getting less back. So it is worth looking into this before you decide whether this is the best option for you, especially if just after cash savings. Trading 212 is currently offering a cash ISA with the same interest rate of 5.2%, so it might be worth checking that out. Although my initial checks once again suggest that this could be invested in money market funds in the same way as the Stocks and Shares ISA. So please ask the relevant questions of Trading 212. My strategy is to transfer £500 from my cash account into my investments on a monthly basis while still earning 5.2% interest on that uninvested cash. And to reassess this every time the interest rate moves, as UK inflation is now a lot lower than it was when these interest rates were initially set. It's possible that the Bank of England will reduce rates over the next few months, and that might have a knock-on effect on the rate offered by Trading 212. If so, I might increase my £500 deposit to get them invested quicker, if it means that I start to earn less interest on my cash. Let's wait and see what happens over the next few months. If you are enjoying this video, then please consider hitting that like button, subscribing to my channel, and to turn on your notifications so that you'll be aware of when I post new content. Moving on to what I have chosen for my portfolio in this ISA, trading 2 and 2 allows you to create pies, and these pie charts are an intuitive way of looking at the proportions of your portfolio. You can also opt to share your pie with others, and you can look at other people's pies for inspiration. My portfolio consists of 3 passive index ETFs, exchange traded funds. I choose passive funds as this keeps OCFs low, as I don't then have to pay someone to pick stocks and change proportions on my behalf. The OCF, or ongoing charge figure, is the fee that you pay the fund manager for its administration. You might also see TER, which stands for total expense ratio, which is the same thing. You would be paying a fund manager more if you were to choose active funds as opposed to passive ones. And that extra cost does not guarantee that you get any better returns. In fact, there's a good chance that a lower cost passive fund will perform better. Fees can really eat into your returns over time, so keeping them as low as possible is something that you should try to do. The other significant fee that you might encounter when investing is that holding or platform fee. And that is the fee that the broker or the investment platform charges you for holding your investments with them. With trading 2 and 2, they don't charge any platform fees. The only charges that you might encounter with them are foreign exchange fees. But these are easily avoidable if you buy investments that are denominated or hedged in your own currency and traded on your own country's stock exchange. So the total cost of my 3 fund portfolio just consists of the OTF for each, and is very reasonable, as you'll see when I go through them. I have made mine a 60-40 global portfolio, and that's 60% equities, 40% bonds. I have bonds in my portfolio to try and lower price volatility, and this might be a consideration if you're a more cautious investor or if you're getting closer to a financial event such as retirement and don't want that big price fluctuation and uncertainty. The value of bonds supposedly moves in a different direction to equities, and this is called negative correlation. In principle, although not always the case, as the markets fluctuate, this negative correlation should keep the price of your portfolio more steady and less volatile. This works in different directions with not such volatile price rises, meaning that it will dampen your returns as well. This is the trade-off from reducing risk, but you should still be able to find an expected return that works for you. A 60-40 blended global portfolio would be expected to give you returns of about 7% a year. And you can dial down the amount of bonds that you have in your portfolio to try and increase those returns, in exchange for dialing up price volatility. If you have a longer investing horizon, then you may want a smaller proportion of bonds in your portfolio, or maybe none at all, as equities are that driver for growth generally, and price volatility should be less of a concern for you. All the index ETFs in my portfolio are accumulating, meaning that the dividends automatically get reinvested, and I don't then have to worry about reinvesting these manually. But all have income versions too if you prefer to get those dividend payments. All the funds in my portfolio are either sterling denominated or sterling hedged, and all are traded on the London Stock Exchange, keeping those foreign exchange fees to a minimum. 57% is in the Vanguard FTSE Developed World ETF, ticker VHVG, with an OCF of 0.12%. This consists of countries from the developed world such as the US, UK, Japan, and larger European economies. That ticker symbol I just mentioned helps to identify the particular fund of choice across other platforms, and the ticker will be slightly different whether you choose the accumulating or the income version of the fund. So the next fund in my portfolio is the Vanguard Emerging Markets ETF with the ticker of VFEG and a more expensive OCF of 0.22%. And this emerging market fund just accounts for 3% of my portfolio. This fund consists of countries from the developing world and includes potential powerhouses such as China, India and Brazil. My third fund is the Vanguard Global Aggregates Bond ETF. This has a ticker of VAGS and accounts for 40% of my portfolio. This bond fund has an ongoing charge figure of 0.1%. And this fund consists of investment grade government and corporate bonds of varying duration of anything between 1 month and 25 or more years. If you see the word investment grade written anywhere, then that is the way that the industry describes good quality bonds, with high yield or junk being the terminology for those more risky, less quality ones. I did think about buying a global fund that included emerging markets. However, the proportion of emerging markets within those global funds is about 9 to 10%, and I didn't want such exposure. Also, those global funds that include emerging markets generally have a higher OCF, as emerging markets are less liquid and more difficult to trade. So choosing emerging markets in a separate fund, where I could choose the proportion to 3%, also meant that I could keep my OCF lower overall, by only paying that higher 0.22% on 3% of my portfolio, as opposed to having to pay it on 60% of my portfolio if I'd included emerging markets in the global fund. As I mentioned before, that 57% that is invested in the Vanguard FTSE Developed World ETF only has an OCF of 0.12%. I also thought about emerging markets on my investing timeline, and given my age, I'd probably have less time for emerging markets to become developed markets. If you are younger, then maybe a higher proportion of emerging markets in your portfolio might be a consideration for you. So let's just check quickly on the performance of my portfolio so far. And I've only made 2 £500 purchases of investments so far. These payments are set up on a monthly basis. And when I make those purchases, with trading 2 and 2, you can purchase in the exact proportion amounts that you have set. It is early days, and the performance data on my portfolio is limited at the time I make this video. The 5.2% interest that I'm receiving on my uninvested cash is getting me about £2.65 in interest per day. And this has added to my total return as shown. We shall see where the interest rates head over the next couple of months and whether I increase those payments into my investments. I'll do another one of these videos in a couple of months' time just to provide you with an update. If there's any other information that you want me to include in these updates, then please let me know. And if you want any information on some of the best Vanguard funds that you could consider adding to your portfolio, then this next video will help you with your research. Thanks very much for watching.